Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Michael Normyle, U.S. economist at Nasdaq, for a weekly review on what we're seeing in the stock and bond market. We're also going to take a look at what is happening around earnings as we're almost near the end of the cycle. Michael, it's great to see you as always. Welcome back to Trade Talks. And what's been really interesting with the movement that we've seen over the past few weeks is that good news is bad news and good news is good news.
Right. We got some interesting data a couple weeks ago almost now where the jobs report came in very strong. We had 528,000 jobs. We fully recovered all the 22 million jobs lost early on in the pandemic. But that was about 2 times as many jobs as were forecast to gain that month. And that was so strong that markets took it to mean that maybe the Fed, all of their rate hikes haven't done enough yet to slow down the economy. And that might mean more rate hikes. So stocks sold off in response to that. Bond yields rose as well. But in the intervening days, we've since got a number of inflation readings that came in lower than expected, with CPI at 8.5%. Then the next day, PPI came in at 9.8%. And import prices also came in lower. So that kind of gave markets a little bit more confidence that the Fed might not need to go to 75 basis points in September. And we've also since seen industrial production come in stronger than expected. And then today we got retail sales, which were flat, but that was because gas prices fell. So if you exclude gas prices from that, then retail sales actually rose a little bit. So you've got a lot of this positive data that's been helping the rally in stocks in the recent week or two, also helped by good earnings data so far. Kind of less bad since markets were kind of prepared for worse results. But the bond market isn't quite as convinced, so they've seen yields go up, and the kind of Fed pivot story, they're not as sold on that one.
Let's talk about that for a moment here with earnings. To your point, there were good top line numbers, distorted by a couple of sectors such as energy and consumer discretionary. But one thing we have noticed was there was really a muted response to those that missed. It seems as if there was a big pass given this past cycle.
Right. It is unusual because typically with earnings, when you get a beat, you see a small gain. And if you get a miss, you get a bigger sell-off. And this time around, we've actually seen a bigger gain about a bigger gain about 2.1%. Whereas for misses, you've seen no change. And typically it's more of a sell-off along the lines of 2.4%. And so that has to do with the fact that, like I said earlier, markets were expecting things to be a little bit weaker this time around. So earnings hasn't been as bad as expected. And we're actually seeing the top line numbers come in on pace for 6.4% this quarter versus estimates of 5.5%.
So, Michael, I guess what the question is earnings driving the market bounce? Because it seems as if it's trading like the Fed is backing off, and that isn't really the case.
Yeah, in the long term, you do see earnings and stocks tend to move together. And that's the result of the fact that when you're buying a stock, you're buying a share of future earnings. But in the short run, with what we've seen this year, it's been more about rates, where the S&P is about 10% down this year, even though earnings are up 6%. So that leaves the price to earnings ratio down 14%. And so we've seen that the sell-off kind of bottomed around when 10-year yields were at 3.5%, which was their peak this year. And so as rates have fallen back to 2.9% now, it's boosted valuations. That kind of helps companies, with lower borrowing costs and stuff like that. So that has helped. It's really been the rates that have been driving the rally more recently.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.